Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, have you ever seen a circus act where someone's on a unicycle on stilts in quicksand? Well, that might be our market, but we're going to tell you why that is and when that might matter. So let's dive in.
Trade Genius.
Hey guys, we got Black Friday specials. They're really cool. We have the best pricing for the year. You can get our basic package, our advanced packages, our VIP rooms, software, trade options, trade crypto, trade the futures. With us, get our indicators, best prices of the year. Take advantage of it. Thanks for listening.
All right, Bob. So to expound on our intro, this market, on the surface, it looks like it's doing really good. It's mustered up, a bull run into the end of the year here. And yet if you open that hood, this thing's misfiring on most cylinders and low on oil.
Yeah, it's really weird, Phil. We had that huge gap up with Janet Yellen after the 31st of October to like the 15th of November, and the market has essentially done nothing since then. We're in our third week now, and it's not so much that it's done nothing, it's become extremely dull. And today, for like the 15th time after the European market closes, the market goes comatose. So I went ahead and pulled up the kind of the market plumbing, if you will, and I want to show you this chart. And this is not just today. This is becoming typical of what we're seeing right now. And because we obviously have a service. We try to find trade signals every day to trade. And for the last 2 days, I can't find anything now. We've had some really big moves in the crypto miners, but you're not chasing a move that's already up 10, 15%. That was a 2 or 3 day move. It's up there now. But looking out today, I'm like, yesterday couldn't find anything. Today couldn't find. And I'm not interested in 0.5%, 1% move. We got the VIX, the daily VIX down below 8 again, Phil. And then here's the market plumbing. What we're looking at here, guys, is this is a standard deviation showing you stocks that are up and down for the day and what percentage they are, and against the normal. So if you look at it, 63 stocks in the S&P 500 were green today. Okay, 12%. Okay, you have 87+% that were down today. But what makes it more egregious is look at the top 10 stocks by market cap, Phil. They're the ones that are driving the market. And people say, well, you should just trade those. Well, if you want to just be in a SPY fund, you can, but most people aren't in SPY funds. They're more diversified. And the other thing too is that you don't know at this point, because the market cap of these are already twice the market value. Like, right now the market should be valuing about a PE of about 15.5, and those 10 stocks representing a PE of 30, okay, in a marketplace that's decelerating. And so, you basically, this is like a recipe for, going to jail for medical malpractice, if you would tell people to jump into these stocks at that kind of PE ratio. But isn't that wild? I mean, it blew me away when I saw it. I'm like, of course I can't find anything. Nothing's moving. Everything's down. I mean, if you look at my watch list, and even the Bitcoin miners, just a cautionary tale, guys, they're starting to sputter a little bit today. And they might be getting a little ahead of their skis here a little bit. So I want to throw it back to you. What's your thoughts on this? I know, you're trading more macro on the future side. So, you drifted some gains today, but this doesn't look like what a bull market is made of.
No, the breadth is totally terrible. And, and like you said, most people, if they're invested in 401k plans or other investment vehicles, they're not as concentrated as these, 7 stocks are, right? No fund manager in the right mind is going to put the retail investor in 7 stocks only. So while you can say, hey, yeah, I just invest in those, that doesn't really reflect reality for most people. And most people's portfolios are not performing at the rate that the index would imply it should be. And I know that because I've seen mutual fund quarterly reports, and yeah, they're not anywhere near what the indices should be. And I kept constantly getting asked the question, why shouldn't my portfolio be up more? And I'm like, trying to explain to them, well, no, because most of your gains are happening in a very small percentage of the stock index. And if you were looking at the equal, they don't even comprehend this, but if you tell them you look at the equal weighting index, then you'd be flat to negative for the year. So I said, be happy that you're up at all. So, it's not something that you normally would see in a healthy bull market. So, and then I think what we're seeing too now is a jobs data is continuing to deteriorate. And it's interesting because the market is being somewhat resilient. I understand that there's year-end flows and things of that nature, but today was a big miss in the JOLTS job data, job openings. Big miss. I think the market's in a holding pattern for tomorrow because we have the ADP numbers coming out, which is, normally we'll get some kind of reactions. And if it's a big miss tomorrow, I don't think the market's going to be holding up going into Thursday and Friday. So, I think at some point those job numbers are going to matter because invariably when you go into a recession, your jobs are going to start falling off a cliff. And we've had so many other metrics now. That was the one thing that you and I talked about we're missing was job deterioration. And we're starting to see that. And quite frankly, Bob, I'm a little surprised that the market has been holding up as well, given that last 3 weeks of jobs data has not been, let's just say hasn't been hitting the mark.
Well, Phil, they threw a $4 gain on Apple into this. This to me is like, hey guys, we got to keep this dam from blowing up here at all costs. Tesla and Apple were the big movers today. Okay, nobody's buying EV, and I can assure you, Apple stuff's not flying off the shelf, for Christmas. So this was absolutely, BlackRock et al. Throwing everything in to keep the indexes flat. But look, the alarm bells are off. You know what we look at. If you have market down, oil down, and yields down, that's pain trade for a recession.
Right.
And the other thing too, which is wild to me, is that the way my portfolio is balanced is that if yields are down, I'm expecting oil up.
Right.
Okay. And that trade has blown up here a little bit. They're just pressing oil hard right now and yields are falling.
Right.
And so just like how the 60-40 thing blew up at the beginning of the year, I think this oil and yield thing is going to start blowing up too. Mm-hmm. And, I had to adjust things a little bit here because I'm thinking this is the recession trade showing up. I'm expecting, yields to fall even harder. So, it's because, typically if you expect, the yields are falling, you get the animal spirits, coming into the market and people are going to think, hey, economic activity is going to pick up, but it's not. And we showed a chart the other day where if there's a good guy here in terms of the rate cuts, and then all of a sudden you get whoosh,
right,
and you get a dump. So now, having said all that, before anybody trolls us, is that there's still flows in there that are keeping this market from crashing. So you can't go all in. Like I said, I'm short for the 15th, long for the 29th, and basically selling calendar spreads until one of those ranges breaks, between 454 and 458, and then we could see where this thing goes. But we had a lot of derivatives come off last Friday, and a lot of people are saying, maybe Santa dropped off some presents early here, and this may not be as bullish as people are expecting. So I'm here just trying to tamp down expectations before people go hog wild, because if we're not moving, they're burning up call buyers and they're burning up put buyers at the same time. And then usually people just start throwing in the towel here. So it could be pretty interesting. I think you want to show in our chart here, if I'm not mistaken.
Yeah, I think we would be negligent to not mention crypto because of just, Bitcoin's basically been breaking out now. So, but what I wanted to point out is that, typically you're going to see a lower high on a rally before the halving, and then we dip down into the halving and then rally after the halving. And historically where we do find a top in that pre-halving pump is at the 50 to 618% fib retrace. So, and that's from the cycle high to the cycle low. So we had our post-halving high up here near 70,000, and we had our post-halving dump down near between 15 and 16,000. So we've retraced over 50% of that. We poked, we got another pump today, but we're in that zone. So, what would be unprecedented is if we just saw candle after candle just walking through the zone, then we might be dealing with something entirely different. But right now, this is doing pretty much what it normally does. Now, so, of course, these cycles are different. This is the largest cycle by range, so the moves are way bigger. But, in 2019, this is a similar move. We had a lower high, and 2019 hit the 618. So if we hit the 618, we'll just crack just over 48K if we do that, and then this rolls over. So if you start seeing it do that move or starts rolling over, or if you get like a weekly engulfing bar up in this area, I think that's a fairly decent candidate for a local top. Now, you have the ETF news still coming, right? And you got to remember in 2017, end of 2017, beginning of 2018, January, I believe it was 2018, the CME futures went live. That was the top. That was literally the day the market topped, and then we went into a bear market. So one scenario you could think of is this could be 2.0 of that, where we rally up into into the ETF approval. I mean, from everything we've seen and all the, stuff that BlackRock is insinuating, we're going to get an approval in January, and we may get all of them approved at once. Now, is that going to change anything? Well, I don't like ever running up into news, especially something like that, because in the history of Bitcoin, that's always counterproductive. You end up selling the news, essentially. Is that going to dramatically change things immediately? No, because we've had ETFs overseas for a long time now. We've had GBTC, which has seen institutional flows into it. So it's not like we haven't had a vehicle to hold BTC for institutions. We have. What we're looking for is a change in the amount of flows that we get. I mean, it's going to allow a lot more flows to come in. The trillions and trillions of dollars that we expect the market cap to attain will be through these ETFs. We saw it in gold in the early 2000s, and gold went on a 10-year run, as we've mentioned before. So I think it's very similar in that regard, but immediately, I don't think you're going to see trillions of dollars flowing in. And sometimes you see that online or comments on Twitter that it's just going to instantly open the floodgates. And I can assure you that's not going to be the way that it works. Now, over time, it will. But if we're going to roll over into a recession, we could have every ETF on every country having a Bitcoin ETF, and it won't change anything. We got to wait for the positive flows to come. But I am very bullish, 2025 and beyond. I'm very bullish. I think that was the last piece of the puzzle, really, to allow real institutional flows to come in. And by that, I mean trillions and trillions of dollars in market cap. So my long term on this, I think Bitcoin's headed to $750,000 over the next few years. And Bitcoin can move very, very quickly. I mean, once it starts to move, you can see on the right side or left side of this chart how quickly that move happened. And you're going to see it again and again and again. But it's going to be a volatile ride. And I think right now you have to be realistic and just say, okay, we have momentum into January. We're going to have negative seasonal flows and derivative flows going from January to March. That could coincide with the news and a selling of the news. And then we reject out of this area ultimately. But it's a hard move to fade. You don't really want to step in front of the freight train at the moment. But things I will tell you to look for are big weekly red candles up here at this point, because that usually is enough to stall these moves out. Or things like, inverted hammers, just stuff where it looks like there's a climax in the candles, either on the daily or the weekly. And that usually, once you're overextended like this, because make no mistake, all of the indicators, I don't care which momentum indicator you want to use or oscillator, they're all pegged right now. And so this is, you're going to get one of these moves is going to be the high, the local top here, and then this thing rolls over.
And what's interesting to me is that usually the Bitcoin miners kind of will sniff this out before the Bitcoin traders do, because those guys are insiders, and they know and they see. So look for weakness in, Mara and Riot, and that might give you a heads up on the market. Remember, they're leveraged good guy and they're leveraged bad guy. So if we do get a pullback, a 10% pullback in Bitcoin would probably be a 30 to 60% pullback in Mara, for example, because they're leveraged right now 6 to 10x. Right now you're getting the good guy move, basically from 25 to 45 here, and you've seen some doubles already in some of these Bitcoin miners. So just bear that in mind. That look for weakness, look for a lower low in these Bitcoin miners. That'll probably tell you that something's up, and then you want to make sure that you're either out of the way or you can buy some puts on those to hedge your Bitcoin position if you like to hedge. So with that, Phil, I just thought it'd be interesting to share with people. This is what we're up against. This is why you can be macro bearish. You can even be stock bearish and not be wrong. At the same time, you can say the market's in a bull mood because of what they're doing with the Mag 7, right? Or the Dirty Dozen, if you will. And that's all carrying the market. But once those guys give way, and they will after January, then you're going to get a magnified effect the other way. So anyway, guys, hit like, subscribe, hit notification. Really appreciate the views. We're getting more and more views every day. Tell your friends. Either you agree with us, disagree with us, doesn't matter. Let us know if we're giving you good information. That's our ultimate goal. And our second goal is to have you join our service if we think we can help you make money. And with that, hit tradegenius.co. And if you're not interested in that, thanks for listening. We'll catch you guys tomorrow.
See you guys later. Bye-bye.
Trade Genius.